Imagine a company so big it could buy every single NFL team, every Major League Baseball team, and every NBA team, and still have enough cash left over to buy a small country. That's Berkshire Hathaway. But behind the legendary Oracle of Omaha and the cozy annual meetings, there's a cold, hard risk matrix that most investors are ignoring. Today we're stripping away the myth to look at the fortress of capital and the cracks that might be forming in its foundation. This isn't just a stock update, it's a forensic look at the future of global capitalism. First, let's talk about the wow factor. $1.22 trillion in assets. To put that in perspective, if you spent $1 million every single day since the Roman Empire was founded, you still wouldn't have spent this much. This is what we call the ultimate gold standard for survival. In the consulting world, we say they have a resilience barrier. In plain English, they are the only ones left standing when everyone else's house is on fire. Their balance sheet isn't just a ledger, it's a physical shield against global chaos. But here's the complication. Even the biggest shield has a weight limit. We found a hole in their pocket the size of a crater, and it's labeled climate risk. Look at Pacificorp. They're sitting on nearly $3 billion in wildfire liabilities. And Geico? A single bad hurricane could trigger a $15 billion payout. We used to think these were once-in-a-century events. Now they're happening every other Tuesday. The fortress is strong, but the environment it sits in is getting increasingly hostile. At HDIN Research, we don't just look at problems, we categorize them. We've broken Berkshire's risks into 3 buckets. First, systemic shocks, the stuff that hits everyone, like interest rate spikes. Second, operational resiliency. Basically, can we keep the trains running on time during a recession? And third, concentration, having too many eggs in just 5 very expensive baskets. It's a delicate balancing act, and the stakes couldn't be higher. Now, let's talk about their secret sauce, the insurance float. Think of this as $176 billion of other people's money that Berkshire gets to play with for free. In fact, it's better than free. Because they make a profit just by holding it, their cost of capital is actually below zero. Most companies pay through the nose to borrow money. Berkshire gets paid to take it. It's the ultimate money printer that never needs to be plugged in. But even the money printer has maintenance issues. Geico is the crown jewel, but inflation is a beast. The cost of fixing a car today is sky high because of all those fancy sensors. Geico had to pay out $1.8 billion more than expected last year, just because parts got expensive. They're raising prices to fight back, but in the insurance world, it's a constant arms race. It's a classic battle, Geico's efficiency versus the world's rising costs. Switching gears to the Iron Horse. BNSF is the backbone of America. They moved 5.6 million units of consumer goods last year. That's enough to fill a train stretching from New York to LA and back, several times. Even though the economy cooled down, they got leaner. They improved their operating ratio, which is just consultant speak for making more money with less fuel and fewer headaches. If BNSF stops, America stops. Then there's the energy moat. BHE is massive, serving over 5 million customers. But here's the cold humor. Being a utility today is like being a firefighter in a forest made of matches. They've invested $38 billion into quote, energy, not just because they love the planet, but because the legal and regulatory pressure to move away from coal is becoming an existential threat. It's a pivot or perish situation. Here is where things get sweaty for the accountants. Look at this table. 65% of their stock portfolio is in just 5 companies. Apple alone is a massive chunk. If the tech market has a bad day, Berkshire has a really bad day. A 30% drop in the market wipes out $68 billion from their bottom line. That's like losing the entire value of a company like Ford in a single afternoon. It's not just an investment, it's a high-stakes bet on the American tech ecosystem. People ask, why is Berkshire sitting on $369 billion in cash? Why aren't they buying stuff? Well, in the words of a wise man, cash is oxygen. When the market is overpriced, you don't buy, you wait. That $369 billion is enough to buy every person in New York a Tesla, twice. It's dry powder. They are waiting for the great devaluation so they can swoop in and buy the world while it's on sale. The biggest risk of all? It's not a number, it's a name. Or rather, a change in names. On January 1st, 2026, Greg Abel officially took the wheel. We are moving from the era of the stock-picking genius to the institutional infrastructure manager. Buffett was an artist. Abel is an engineer. The canvas is changing from oil paintings to blueprints. Greg Abel isn't looking for the next hidden gem in the stock market. He wants heavy assets. He likes things made of steel, concrete, and wires. His $9.5 billion purchase of OxyChem is a perfect example. He's doubling down on the industrial heart of the company. It's less Wall Street and more Main Street if Main Street was owned by a trillion-dollar conglomerate. So what keeps the new CEO up at night? Two things: interest rates and market crashes. Higher rates actually help them because they earn billions more on their cash. But a market crash? That's where the GAAP earnings take a hit. Berkshire is now positioned like a giant battleship. It takes a lot to turn it, but it's almost impossible to sink. Don't forget the hidden Berkshire. They own manufacturing plants in 58 countries. From precision aerospace parts to the chemicals in your shampoo, they are everywhere. This is their global barometer. When these factories slow down, we know a recession is coming before the news even reports it. They don't just follow the supply chain, they are the supply chain. The bottom line? Berkshire is no longer just a fund. It's the world's largest infrastructure utility. It's the company that keeps the lights on, the trains moving, and the insurance claims paid. They have $369 billion in oxygen and a fortress of capital that is built to last centuries, not just quarters. The Oracle may be stepping back, but the empire he built is just getting started. Thanks for watching this HDIN Research Deep Dive. If you want the full-page forensic report on Berkshire or any other industry giant, reach out to our team. Don't forget to like, subscribe, and hit the bell, because in this market, the only thing more dangerous than risk is ignorance. See you in the next one.